All right, I want to thank you for joining me for my second Ask Me Anything session. Today, I'm going to take a look at the investment fees that you may be paying. Most people will find really don't know what they're paying for financial advice. So fee transparency is really important. If you work with a financial professional, and even if you don't, do you know what you're paying? Because a lot of times, even when you're not working with a financial professional, there's still fees that you're paying. These studies go back to 2017. I couldn't find anything more current, but they found that somewhere between 40 and 60% of investors really don't know what they're paying in investment fees. And just let's take a look at why this is important and how fees can impact your investments. So I'm going to talk more about some of the columns on this, but you'll see like there are mutual funds that if you work with certain types of advisors, they have what's called a front-end load. And what that would mean is that you pay a fee up front to buy into that fund. So for example, if you had a 5% front-end load, you would pay $2,500 just to invest in that fund. And then that means you only have $47,500 working for you. And that $2,500 is really going to the person that sold you that fund. And then funds have expense ratios on top of that. So if you look, if you had an 8% growth rate and you paid that front end load fee, you'll see the difference, that $2,500 that you paid up front, like at a 0.5% expense ratio, that reduced the ending value of your portfolio of over $22,000. So it had even a bigger impact when you look at it over time because you had less money working for you. So here's a list of all the different types of fees, or at least most of the different types of fees. There's front-end load sales charges, there's back-end load or surrender charges. There are some funds that are called no load. There's 12B1 marketing fees, there's transaction fees, there's something called the bid-ask spread, and a whole host of others. And I'm going to go over all these in a little bit more detail to give you a better idea of what you might be exposed to. So the first thing are loads and marketing fees. So a front-end load, as I showed in that example up front, that's paid when you purchase some mutual funds. And usually how much you pay for those kind of funds, they have a share class, and that share class dictates how much you pay for the fund. There's also things called back-end loads or surrender charges. Those are paid when you withdraw money from your account. So if you buy a mutual fund that has a back-end load, that means that if you sold it like within the first year, then you might pay a 5% fee. If you sold it in year 2, you would pay a 4% fee when you exited, and so on. And eventually it goes away. And that can also happen in the case of annuities, where you have bigger surrender charges because the salesman that sells you that annuity, they get a big upfront commission for selling it to you. And that surrender charge is to help make the insurance company make sure that they can collect the commission that they paid to the salesman. The 12B1 fees, these are distribution or service fees that are used to promote the fund. A portion of those may also go to the advisor that sold you that fund as part of his ongoing fee or commission. Like I said, there's no load fund where you don't have any of those type loads. And generally ETFs, which are somewhat similar to mutual funds, what I generally use when I manage client portfolios, those don't have loads. And then there's also certain types of brokers that you work with that they have what's called a wrap fee. And that's a single bundled fee that's paid for your investment advice, your brokerage services, your administrative expenses, and all your other fees and expenses. So it's just all wrapped up into one. So let's talk about transaction fees. So transaction fees, there's really two different types. One is commissions. And in October of last year, commissions became much less of a factor than they used to be because most of the major discount brokerages that many of the advisors work with reduced their commissions to 0. That's on stocks and ETFs and on some mutual funds. There still some mutual funds that you might pay a commission. I know I have some clients that come to me with mutual funds from other firms, and sometimes we pay a $25 or $49 commission to sell that fund. And there's also something called a bid-ask spread. And what that really is if you look at any stock or you look at any ETF, anything that trades on an ongoing basis during the day, it has a bid-ask spread, and that's the difference between what you would get if you sold it and what you get if you bought it. And right now, for many funds, that's only a couple pennies, so it doesn't add up to a lot. There are times when the market gets more volatile that those spreads get wider, and they can matter. And so what that really is, it's a cost of trading. And so it's another reason that it's best to just, if you can, just stick with a long-term portfolio, because you get hit by those things less frequently. Now let's talk about fund expense ratios. That's something that a lot of people aren't aware of. When you have a mutual fund or even an ETF, there's a company that's managing it for you. And those funds have operating expenses. And so they pass some of those on to the fund holder. They're a percentage of the investment. And so you see, I picked a relatively inexpensive one below. It's a S&P 500 ETF. The ticker symbol is SPY. This information came from Morningstar, and Morningstar.com is a good place to go if you want to understand what the expense ratios of the funds that you own are. And you'll see on there that on the bottom, the bottom row, the second one from the left, it says expense ratio, and it says 0.095%. So what that means is that there's a typo on my slide. I apologize for that. The 0.095% expense ratio below translates to paying $9.50 for each $10,000 that you have invested. And there are some funds that have much higher expense ratios than that. I know I've had some clients who came to me and they were working with brokers who weren't fiduciaries and weren't acting in the best interest of their clients. And they picked funds that would pay them the most money. And I've seen some that have expense ratios of 2%. And you can find comparable funds that do really the same thing that have very different expense ratios. The most expensive S&P 500 type ETF has an expense ratio that's well over 1%. And I can find them even cheaper than the SPY one that I have here, much lower expense ratios. And they do matter because they have an impact on your returns. Then there's fees. If you're working with a financial professional, you are going to pay fees for advice. So some advice to you is to make sure you know what's included, right? And how are the fees calculated? For example, if it's a percentage of managed assets, how is that structured? It can be a stair step. And what I mean by a stair step is that a lot of advisors, they might have one fee for the first $500,000. And let's say that's 1.25%. And then the next $500,000, the fee drops to 1%. So the combined fee, if you had $1 million portfolio in that case, would be $11,250. On the other hand, there's also a cliff structure, and that's really what I use for a prize. And a cliff structure means that if you had $1 million invested, you would pay the expense ratio on the whole portfolio at the rate that applied for $1 million. So that in my case, it would be 0.8%. And that 0.8% would only amount to $8,000. And you wouldn't pick up the higher fee that applied on the first $500,000, which in my case, again, would be 1%. So it saves you a little bit of money because of the stair-step structure. There's also flat or fixed retainer fees, and I do have some clients that pay me on that basis. And a flat or fixed retainer fee mean that an annual fee is determined. Typically, it's paid in quarterly installments, and it's taken from your investment account and paid to the advisor. And then there are some advisors, and I do this on occasion myself, where you have hourly or project fees. And in that case, you agree on a rate or a project fee, and then you're billed based upon that. And if you're not sure how much an advisor charges, my best recommendation is to review the firm's Form ADV. You can find them at the SEC, the website I provided for the SEC. And what you do is you go to that website and you put in either the advisor's name or the firm's name, and that should help you find their Form ADV. And what you really want is Part 2, not Part 1. Part 1 has information, but Part 2 is where you're going to find the fee structure. You may also find it some on firms' websites as well. Then if you have a 401k, there's fees for those. First of all, we talked about expense ratios before. When you have a 401k, most of the funds that are in those 401k accounts have expense ratios. But these are, what I'm talking about here is a little bit beyond that. These are charged by the firm managing your account. They may be paid at least in part by your employer, and whether or not they do that and how much they pay. And that's partly going to be based upon the size of the company and the number of people in the plan. Then what does that fee cover? It covers administrative costs, it covers record keeping costs. And if the firm has an outside investment advisor that's looking over that plan, that part of that fee also goes to them. The bottom line here is know what you're paying for, know how you're paying your fees. They can be paid directly. That could be through a check, billed to your account, be trading commissions or other means. Don't forget about the expense ratios. And then I also have a link here to some guidance from the SEC, where the SEC put out a document that talks about what the impact of fees is on your investments. And if we go back to that earlier slide, you can see, again, just to remind you, you see that those expense ratios and those expenses that you're paying, like look at the difference between a 0.5% and a 1% expense ratio on that $50,000 that's invested for 30 years. You can see that the difference in what the ending value of your portfolio is $37,000 in that one example. So they do make a difference. And it's not saying having advice makes a lot of sense for most people, right? Because we have to, in order to be able to do this ourselves, I like to refer to what I call as KIT, which is having the knowledge, interest, and time to do it yourself. And there can be benefits to working with a professional, but if you do, make sure that you understand what the fees are and make sure that you know what you're paying. And then that's the kind of the pre-packaged or canned part of the presentation. Now I'm happy to take any questions that anybody on the call might have for me. And I see you've all muted yourself too, so if you want to ask, be sure to unmute.
It's hard to phrase a question after looking at all those fingers in your money taking small percentages and trying to really appreciate how that affects your long-term yield. You know, I mean, you know it does, but when you see all those percentages and all those little, what seem like crumbs really aren't crumbs. They're big pieces of bread.
You see it.
Does that make sense, Philip?
I'm sorry, I didn't hear the end of your question.
Those little crumbs are not crumbs. They're big pieces of bread.
They are, because you think about them, they sound small, but they add up over time. And that's the key thing, right? Because in that example that I gave, that was a 30-year time, and it was $50,000. The numbers don't, so they look pretty small up front, but over time, they make a difference. You know, that's why, so when I manage a client portfolio and I'm using ETFs, I look at the expense ratios very carefully, and the weighted average expense of the funds that I use in client portfolios is 8 to 12 basis points.
In the back of the thing, I think.
And the reason is because I know that expenses are important, and I know that if you're working with me, you're already paying, and I want to do my best to keep the other expenses you're paying down as much as possible. So you can typically find a comparable fund that's cheaper for you as an investor. And if they're all comparable, there's no reason not to.
Because you were able to do that for me by analyzing our 401k and all the fees and costs hidden in that. So that was great. Thank you.
You're very welcome.
Camera. All right.
I don't know why they don't have us.
The smudge up there.
No, that's not the camera.
Are there any other questions today?
Hi, Phil. I have a question. This is really helpful. Thanks for putting it together.
You're welcome.
My question has to do with, you know, currently a lot of institutions are switching to accepting payment electronically only. And I'm finding that's the case with my kid's school. The private school tuition, typically,
Messed up for some reason.
their tuition in different installments, and everything now is required. Even when paid in full, it's required to go through the processing house or the clearing house. The school that they're attending uses TADS, TADS. But my question for you is, I'm fortunate that my dad is able to help pay some of the tuition. So the checks, the school doesn't accept checks anymore. Everything has to come from one account and has to be processed through TADS. So if, formerly my dad would write a tuition check payable to the school for part of the tuition, I would write a check. But now everything has to come electronically and has to come from one place. So, my dad can write a check to me, but is that going to cause a taxable event for me? Even though I'm putting the money through to school tuition, that money hit my bank account for, a period of time. So I'm just trying to look for sort of a clean way of, and you and I can talk about this, more offline, but I'm imagining that other people are going through this as well in terms of, having to get funds together for electronic payments.
So I have not run into that yet. It shouldn't cause a tax problem for you because it's really not for your benefit. If anything, the rules on gift taxes, which is really what would apply there, have changed. So the annual exclusion is pretty large. If I'll think about it more, Rosalie, and like you said, we can talk about it offline, but I would think that you might need to at some point, I don't know the amounts, but it's possible that you might want to file gift tax returns protectively just to make sure that there's no consequences. And a gift tax return, there's not any tax due with it. It's just to show the exchange of money. That's really all it does. And it protects you. Because the lifetime exclusion is so large that a single gift, even if it was more than the annual amount, isn't enough to cause anybody heartache at this point in time, for what you're talking about. But we can certainly follow up. I'll look at it some more just to make sure that I have the best answer for you. But I know it doesn't cause a tax issue. You just might have to do something proactively just to document it all.
Okay. Thank you.
You're welcome.
I think that's all I have.
All right. Are there any other questions for me today? All right, then, if that's it, I'm going to end the session. I don't want to keep anybody unnecessarily. I want to thank you for joining, and I'll be back again. I guess it's now in 3 weeks because I'm on a second and fourth Wednesday of the month schedule, and there's an extra Wednesday this month. All right, so thanks for attending, everybody. Take care.
Thanks, Phil.
You're welcome.